Good afternoon, everyone. Good morning, good evening, depending on where you are. Welcome to the second day of our Kiel CEPR workshop on China and the international financial system. We really enjoyed yesterday's discussions, the paper presentations, and we're excited to see many of you coming back for the second day. Today we'll have 2 more sessions, 4 more papers, all of which dealing on China's growing role as a creditor to developing countries. We have a very interesting session this morning that will in particular focus on China's growing role as an important player in debt restructuring negotiations. We have 2 brand new, very timely papers by Laura Alfaro and by Aitor Erce that will deal with how Chinese creditors are interacting with the existing debt distress resolution architecture, how they're interacting with other creditors. Thank you, Laura and Aitor, for agreeing to present in our workshop. And for those of you that have not been here yesterday, the ground rules remain just the same. We're aiming for 30 minutes of presentations, followed by 15 minutes of Q&A. You're very welcome to come in with clarifying questions during the presentations or to participate in the discussions. Just write into the Q&A chat or raise your hand so that we can unmute you. And with that, I'll hand over to Laura to kick off the first session. Thank you very much, Laura.
Can you see my slides?
Yeah.
Yes. So thank you to the organizers. I'm going to present some ongoing work with various co-authors, Kanchuk, Guler, Kusan, Taskin, that has been evolving as the amazing trio of Sebastian, Christian, Carmen, have allowed us to understand the patterns of lending by China. But I decided also to take the opportunity of this workshop, which brings the bright minds that are thinking about this to think a little bit out loud of some of the topics that we have been slowly thinking of. And I say slowly because, again, I think new data has allowed us to rethink a lot of these patterns, but also these are not easy problems. And that's where I want to understand it, to start perhaps going back to try to establish or reaffirm why this is a complex topic. I think sometimes in the international, we don't get enough credit that we're trying to answer the really, really complex and big problems. So in general, understanding borrowing and lending, even if we wanted to do it in a country's complex, as we all know, by definition, it will involve a commitment to pay later. And this always has some contingency, but we all know, and again, we all know that is going to have problems, asymmetric information, moral hazard, adverse selection, problems of not enforcing, a contract uncertainty on top of incentive problems to use the resources productively, and coordination problems. All of these exist if we were going to use a closed economy, but at the level that we study them, they just get worse. And this is not adding the topic of currencies, because by definition, they involve government sovereigns as explicit or implicit parties. And so this by definition means that the governments can choose to pay or not, and we get willingness versus capacity to pay. And as we all know, we have tried to create substitutes for the effective enforcement of property rights that have led governments or parties involved to roundabouts, if you want, risky debt structures or inefficient solutions to this big problem. But this also has meant that already coordination problems, when we had different assets, different creditors, get even more complicated because we now have quasi-sovereigns, government firms, supranational, bilaterals, multilaterals. And I think a lot of these topics were addressed yesterday as we were going granular in trying to understand, in the case of China, who's lending where, how, tax havens, quasi-government owned, so on and so forth. And it's probable that this was always the case, and has always been the case. I just think China has made it even more evident, and it has become harder to avoid these complexities. And so, again, the work that Horn, Reinhardt, and Trebesh have done in a series of papers have allowed us to understand New Kids on the Block, as I called it in a presentation that after watching Air, the 80s movie. And again, put debt problems back on first page of most newspapers. And so we have seen the growth of debt, and we have seen the growth of new parties, and in particular China, but also other sovereigns, and the evolution, because I'm old enough now to have lived through the crisis of fund syndicates, the crisis of bondholders, and now the crisis of sovereigns. Previous decades had sovereigns. There were implicit parties behind that also complicated the resolution, or perhaps at some point made it easier, but now it's clearly sovereign to sovereign, some of these interactions. And so they have uncovered, and again, if it's not properly cited, but all of these Starlight facts come from their work, we have uncovered interesting facts. So first, a lot of the lending is now to poorer countries. It has more dispersion, but overall, we do see a lot of more lending to poorer countries. We do see more defaults happening at lower output levels. And we also document that these are associated with lower output costs. And so, again, depending on the definition you use, whether it's a default or a restructuring, we're just seeing more of these phenomena. And again, this has been documented by the organizers of the conference. And it's interesting that it used to be defaulting on private, sovereign to private. And I argue that a lot of our models are about this. We now see a lot of sovereign to sovereign, and it's not clear to me our models are really about this. We're gonna use them to try to match some facts, but I think a bigger question is if we should rethink even the motivation of the lender. Again, this just shows the same phenomenon that we just now see. A lot of defaulting disproportionately to China. China is red, private is blue. Before it used to be sovereign to private, now it's sovereign to sovereign. And it perhaps concentrated also in lower debt levels, but since we have more heterogeneity of parties and a lot of small countries, some of these tend to be outliers in terms of the debt to GDP ratios. But it used to be more concentrated in middle income countries, Latin America. Now it's all over in terms of ranges and outliers. But I would argue that a lot happening in poorer countries. Another, again, comparing the facts is that different rounds of crisis have led to faster reentry. But now with China, we do see a lot of reentry. And again, it depends how one is measuring the default or the restructuring. But we do see countries now gaining access faster relative to what we used to see in the 70s and 80s. Another fact that we have tried to revisit, and again, this is always complex, endogeneity is always an issue, but we try to assess whether the defaulting to China is related to lower output costs. And what we find is that, in particular, defaulting to China, it is somewhat associated to lower output cost, or if anything, no cost. Not only relative to the defaulting in the 70s, 80s, and 90s, but also relative to defaulting to private creditors today. And this is work, I saw Hugo yesterday, I don't know if it's today, that has documented this the output costs. We find them there still for private creditors, but for China, again, I'm more careful is we don't see the dramatic negative costs. If anything, some seem to actually be happening in good times as well. again, one needs to be careful, a lot of the endogeneity concerns, and also when does the default start, when does it end? But overall, doesn't seem to be as dramatically related to negative output costs as it was in previous rounds. And also, and we're trying here to document some of the more stylized facts, it's just not the same countries, except for Argentina. So Argentina will always be there. I argue that Argentina is an outlier on its own and deserves its own field, and it's very hard sometimes to generalize from Argentina to other countries. But other than Argentina, that keeps defaulting to everything and anything that moves, the countries that we saw defaulting, and the famous countries that we saw defaulting in the 80s, I have here Colombia. Colombia didn't default, but Brazil, Mexico, Chile, they're not defaulting now. The players that are defaulting now are different, except perhaps a couple there. But we see different players. And I mentioned this because a lot of the things we still tend to do is based on the defaulting of the 80s and 90s, and we still talk about Brazil, Costa Rica, Chile, Mexico, but these are not the defaulting countries. And we need to think when we would allow a country to graduate in terms of that expectation of it is one of the countries that we target or benchmark against when we're looking at defaulting. And so again, we're trying to document some of these emerging changes in the landscape and how we think sovereign default. And it's a slow process because as the authors of the conference have documented, is hard because a lot of these facts are not transparent. And that is also a characteristic. I say relatively because it was also the case in the 80s and 90s that once countries defaulted, we will find what we will call skeletons in the closet, that we didn't know that it was, but it was not as in your face as it now, and has been documented that now countries sign confidentiality agreements. Like before, that was not the case. It was more like decentralization, different units were borrowing, it could be corruption, it could be many things, but it was not in your face, let me hide this debt through a legal document. And so we're trying to think broadly about this topic that overall it seems to be now associated with different players, more defaults, less output costs, at lower output levels with more heterogeneity and more transparent. And so we have been trying to think of different ways to tackle this because we're not as smart as other researchers to try to do it broad. And so we have tried to dissect and look at different topics of this. I think one big topic is the interaction with other lenders, be it in the private or sovereigns multilateral. And so in a paper that I published in the Papers and Proceedings, we look at the competition with private lenders. And most of the sovereign debt literature has been about this, borrowing from a private lender. And we also looked a little bit about the role of collateral, very limited so far. In new paper that we have been working on, we have also looked at clauses like concessional and grace periods, which also characterizes multilateral lending. But also more broadly, we want to start thinking about the competition among multilaterals. And that was a comment that Christophe made yesterday, that perhaps who's messing up is not necessarily China, it could be the multilaterals and their approach to debt relief. And more generally, this all leads to questions of strategic default. When do we default to one partner to one player versus another? In a world that in theory, we cannot default to multilaterals, IMF, World Bank. There's some roundabouts around it, but in theory, we cannot default. But as I said, and I think this is something we should start thinking, and probably is beyond economics, and we need political scientists or different fields. What is the motivation from the lender side? So far, as I said, we continue to use the risk neutral and we tweak it, but this probably is a bigger question that we need to ask when we're thinking about sovereigns. And so again, a big topic in this has been the role of lack of transparency that has been documented in many ways. And this is from the World Bank. And taking from the work by the Horn, Reinhardt, and Trevish, they have highlighted this, that they're, and also the work with Gelper and co-authors, that in particular, this type of lending, and I do think this is different from different rounds, has non-disclosure agreements, the arbitration is unclear. I saw the contracts with Costa Rica. In some cases, it meant arbitration in China, which I also felt was very unclear what that meant. And you had to go there, you wouldn't know what would happen there. And this has posed challenges, because in a way, then private lenders do not know amounts of debt, risk, and implications. And so there are different questions in this topic. One that we have tackled, again, in some limited work, is what are the welfare consequences and what was the outcome from the private players' point of view of increased transparency, and also what are the welfare implications from the borrowers. And broadly, what we find is that this does reduce private lenders' debt sustainability, does lead to more defaults, but it of course leads to firms, governments wanting to borrow from China. On top of that, collateralized debt does reduce even more private lending sustainability, but disclosure increases sovereign welfare, but of course reduces sustainability from the player that was relying on non-transparency. The way we tackle this, we use the traditional models, and this has been sort of our approach. We're trying to tweak little by little the traditional models, and that's a big question. Maybe we should rethink overall the traditional models and do more radical changes. But so far we have tweaked the traditional models, in this case to allow two players, which would have basically the same preferences, risk neutral. And again, this is something that perhaps we all should rethink. And the difference is that how much information is released to the different parties. We have the traditional preferences. Household wants to smooth consumption, and to smooth consumption, they would default optimally on the debt. And the government that defaults on the debt can be excluded, and also would deal with output costs that, as I mentioned, seem to be different when you default to private and China. So we use the simple traditional model. So the sovereign can choose to default on investors, private investors, and will face some output costs. It can default on non-Paris Club players and face a cost, or they can default on both. And so we think of different scenarios. One where we're just private, before Belt and Road Initiative, if you want. The current, when we have both, but one is transparent. One, when we have transparency. To start, we calibrated to Angola, which is one of the countries that has borrowed the most from China, and we're trying to extend to other countries, as I mentioned, and I showed a table of different countries that have been engaging with China. We use standard parameters in terms of risk aversion, persistence, and output costs. Here we calibrated the output cost to the China Angola trade relation, and then we match sovereign debt levels. So the simple, with only international debt, private lenders, we match that debt level around 40%. And this is also, I think, another discussion that we should try to think. A lot of this debt not only has private debt, but also multilateral. So far, we just match to their debt. But again, this leads to the second type of question. How are we thinking about the different players sovereigns are engaging with? But so we match the debt level, and we match the spread over the last 16 years, and we normalize debt to 0. We then include the non-Paris Club players, and what we find is the first effect is that we do reduce debt sustainability quite drastically, and we also get more defaults. However, we increase welfare. And the reason why we increase welfare is because these type of debt are not perfect substitute. So in a world where you start defaulting to a private sector, you can start using China's debt. The problem from the private sector point of view is that they don't know how much debt the country has. They don't know what is the default probability. And so they're going to charge higher rates. And that is why the country starts to move to the defense debt as well. And again, this is some of the explanation. And again, we're also assuming these different, that these might lead to different punishment and defaulting. And then we look at the world where there is a full disclosure. And what we find is that debt sustainability increases for the private player, but of course, it will go down for the non-Paris clubs. Having said that, welfare increases because now there's also going to be a lower cost associated with lower perception of debt and defaulting. As I said, we're trying to play with some of the different clauses that have been, or parameters that have been used in this literature. And of course, if we change the output costs and we make it different, we are going to change the sustainability, and we are also going to change probabilities of default. And so again, this is something that we need to think of whether we impose it in our analysis or if it's an endogenous outcome of something else. The other parameter that is critical in this literature is the sovereign impatient, which is a proxy of, if you want, investment opportunities, long-term growth, and we all have been putting this on beta. What is interesting is that the more impatient the sovereign, it decreases the China's sustainability and is particular sensitive to this parameter in the analysis that we're doing. The other robustness that we are thinking of is the role of collateralized debt. And in general, of course, if there's going to collateralize debt, it's going to increase the sustainability of the player that has collateralized debt. This is just by definition. A short way to think about it is just there's less output available for the non-collateralized party, and thus this does affect the relation and the sustainability. And again, this is how we are thinking about the role of collateralized, and it does reduce the sustainability for the private agent. So again, what does this mean? That undisclosed debt reduces the sustainability, causes more default. However, a more transparent environment does lead to higher welfare for the sovereign, but at the expense of non-Paris club debt. And so we're thinking, of course, lack of transparency might be one incentive to borrow from China, but are there additional ones? And this is where we're trying to think of some of the different clauses in addition to collateralized debt. And we look at grace periods. And again, it's interesting that a lot of their loans seem to have grace periods. The concessional loans, of course, having more zero interest, a form of concession where you just don't charge interest relative to commercial. And there's some disagreement in terms of interest rates. Yesterday, there was a discussion that they do seem to charge more than multilaterals, and I think that's the case. Is a little bit more complex to analyze relative to private, because again, a lot of the contracts are not available. But it used to be this view that they were charging lower interest rates. I don't think that's the view nowadays. And again, even in terms of some other terms that the maturity is longer, we all know that also private debt has extended maturity for many countries. so in this paper, we focus on the role of grace periods, and grace periods. Sebastian, if you're trying to signal something, I don't see the.
No, all
so,
good.
So
you still have 5 minutes left. You're perfectly in time.
Okay, yeah, I think I will finish a little bit early. So in terms of the grace periods, the way we think about this is that there's just going to be some period in which you don't have to pay coupon payments. And so they eventually apply to the principal. And we look at what are the implications of having this devolution of China's debt, that is the one that is going to have this particularity. We don't impose it to the private sector. And so, again, we match some of the moments of the data in terms of private debt, China debt, and then also the spread and default rates. And the dynamics of grace periods is that it does increase the loans, because there is a moment where you just are not paying those interest rates, and then the sovereigns are just increasing the debt. Eventually, this will imply in higher rollover costs, and so you don't have the rollover costs, and then you have a crisis period, and thus also a higher probability of higher default. But this grace period does increase the willingness of sovereigns to go to China and borrow from China. And we're also played a little bit with the dynamics. And again, this does depend a little bit on how one thinks of the accumulation of the debt. But we do see that some of this gray period can emulate some of the dynamics in terms of some of the build that we have seen in terms of the debt with China, and also perhaps some of these increased default rates. And so, again, the way we think about this is that some of these clauses, non-traditional, non-disclosure, collateral, grace, have tilted incentives towards borrowing from China, have also tilted incentives towards more debt and more defaults. What we're trying to think more generally is, again, this strategic default, adding more the role of multilateral players. But as I said, every time we're thinking about this, one question that remains is, what is the motivation of the lender? So far, as I said, we keep thinking about risk neutral, that want to maximize some idea of profit. And probably that is still a good approximation. Maybe we just need to extend what is it, that profit that they're maximizing, and probably also what is the long-term, the different terms. Some may be more short-term, some may just be having a long-term horizon. And just to conclude, as I said, I think we don't get enough credit of how complicated this world is, because we just not only have the debt where parties can play with long-term and short-term as a solution of a lack of enforcing mechanisms, but we also have different type of players, public and private. And within the world of public, we also have different type of players, official, bilateral, multilateral, in a world of ever-changing type of assets. And with that, let me conclude.
Thank you very much, Laura. Very interesting and very useful framework, I think, to think about the implications of all of these different clauses. So super fascinating to see that. Let's open it up. Just raise your hand if you're in the audience and want to ask a question, or Carmen, please go ahead.
Well, glad to be able to be here today. I was unable to join yesterday for personal reasons. So Laura, I agree with Sebastian. It's a great take. I think the now versus then, the China versus other is a really big area that we need to understand. And I think, this does a really wonderful, tour of it. I have three concrete questions, comments. So one is on the reentry question, in which the theme is, in general, reentry is faster in these cases than it was previously. I think there one has to be also careful to, so I have two comments on that. One has to be careful between comparing more idiosyncratic crises episodes, that is a year in which there are not a huge number of crises, versus the global episodes. The 1980s and 1930s were notorious for being long-lasting with very slow reentry, but they were global. So far, we're not in global territory. So I think the issue between if you default more idiosyncratically versus a more collective debt crisis, I think is an important issue. The other issue with reentry is, and I think this is indeed new to the Chinese lending, is, as you know, Sebastian, Christoph, and I have mentioned, repeatedly, China's restructurings are off the radar screen of the credit rating agencies. So, you restructure with China and you're not spooking all the, the global financial community. You don't have S&P and Moody's, telling everyone we've downgraded them to default status because, of a late payment or, or a debt restructuring. So the being off the radar screen, I think, is an important factor there to feature into the why maybe they don't last as long. Very, very quickly, I do want to make a couple of other points, and the issue of who is defaulting now versus then is also a very interesting issue. And I think you're on the right track that they are different, but be careful. I think your the table that you show is misleading, because Ecuador was in default in the 1880s and it's in default again today. So was Angola, so was Ethiopia. So the new entrant, the new defaulter is Sri Lanka, but the others were also in default in the 1980s. I think the way I would take the angle that this time is different is that we have not yet had a major EM default. I think that is the big difference. And, in the defaulting in the 1980s, we could put a question mark next to it. I'm not classifying Egypt as a large EM, but we could put a question mark whether, they're en route there. Finally, I think I would add to your list of I found the very interesting, the work on incentives to borrow. I think we also have to look at willingness to lend. And it's very interesting that the new entrants, the new lenders in the current wave of global lending is not just China, but also bond holders, new bonds, the old lenders that got burnt in the 1980s and 90s, the syndicated, the bank loans. The banks have been more cautious, and the Paris Club official creditors, which ended up offering HIPC relief, have also been much more cautious. So I think you have to explore the issue of willingness to lend as well as willingness to borrow. Let me stop there.
Laura, I think it makes sense for you to respond right away.
So you have validated my view that I should use this conference to start thinking and getting ideas of how to tackle this. Our main motivation was that I think we're still applying a framework that we developed for the Latin American crisis of the 80s. I think a lot of the sovereign debt quantitative models are inspired by that, and some things have changed and perhaps some haven't. And it does get into what is it that we're trying to match. As you know, a lot of the literature has tried to match Argentina, and I think Argentina is a complex, but it does get into, are we attacking or modeling systematic, which was Latin 80s, or what we see now? And then we need to do a better job in trying to come up with what are the stylized facts. And so your comments, I think, give us a lot of thought on how to do this. Having said that, I still think people have this idea that it's the Mexico, it's the Brazil, it's the Chile. And so far they're not. and so we need to think how to do that. But other than that, I think all your comments are things we just need to be careful when we do our analysis. I just don't have anything to rebut.
Jesse, do you want to go next?
So really interesting. Something that I was just thinking about as you were talking, I'd be curious if you could talk a little bit about, have we seen kind of selective defaults either on China or on bondholders not China? And just generally, I was curious if we have any way to think about if it's kind of easier to selectively default on China versus bondholders than selective default would have been with any creditor heterogeneity, like bondholders versus banks. Is there something about China that makes selective default easier or harder, or how does that, do we know how those incentives have changed?
So again, I'm looking at the data, and I know some cases, I don't know if I can disclose. I think perhaps it's related to what Carmen said. Because they're not transparent and they're off S&P, it's easier to default on them without triggering a lot of clauses that will bring down everything. But yeah, it's related to this lack of transparency. But this lack of transparency is also true that it's not spooking everyone because the clauses are not triggered. But the private have to think that there's more debt than they know, and they also have to think that that means repayment. And I think that links to what Carmen mentioned, that is probably why the ones who have been burned in the past don't come back again. It is new ones. And as you were saying, I was trying to think if it's because of regulation, because we do tend to impose a lot of regulation on players that have defaulted before. And so banks have regulation and perhaps other players, and we don't tend to do it for the next round. And also there is more scrutiny. The ones who did it or went into some debt relief efforts, there's probably now more scrutiny by, I don't know, constituencies, so on and so forth. So whether it's regulation or is there something more in these incentives to default? But from the data, there are cases that you're defaulting on one and not the other.
Aitor?
Yeah, thanks, Laura. Very, very thought-provoking. So I'm going to take issue with. I completely agree about the fact that the lack of transparency is problematic and probably it generates multiple inefficiencies. But you know, like the Paris Club is based, the whole Paris Club architecture is based on a number of principles that the Paris Club has, one of which is confidentiality. So talking of transparency, I think that from the perspective of debtors, I mean, they knew what was going on, but they've been for many decades unable to tell what was really going on, because a lot of what was going on with the Western official sector was not really open for the public to be read. So, and thinking in the terms of today, and also because I think it's important to address this issue in the right way, depending on the cases, right? You could calibrate your model to Chad, which is the first common framework case. you could model it to child, just to find that the most aggressive, crazy, collateralized, rent-seeking financial structures were being provided by Western companies, right? Commodity traders. So, and then maybe another thing that I think also because of the huge level of exposure that the IMF is getting in some countries, this whole idea that countries do not default on the IMF, and it holds no water. So Greece, and this was very recent, and it's like someone that had graduated from default, Greece defaulted upon the IMF. The thing is that the IMF, the way that IMF borrowing goes, is up to the board to determine when the grace period for covering for curing the default is gone. So I mean, like, you could default on the IMF, and the IMF could stay for a long time without declaring a default. And actually, the Europeans engineered a loan through one of these bailout funds in order for Greece to be able to pay back the IMF, because Greece had very few money left, and Greece had chosen to pay a Japanese bond instead of an IMF loan. So you see, it's just to bring some notion that some of these ideas that I think we have fixed on stone are there to be shaken, because they are not that true. Thanks.
No. So let me start with that last one. I don't know if you heard when I said, in theory, you cannot default to the sovereign, to the. In practice, hey, I'm from Latin America. There's Argentina. They give a loan. They know they cannot pay, and what they do is roll over the loan and give them some extra cash. And in fact, we're trying to think how to model that precisely of that. If we put that in your face, they cannot default to the multilaterals, or we model some trick that can allow.
Yeah.
And the way we're thinking is we need a little trick, because
it's going to make a difference. It's going to make a difference.
Yeah, but in theory, you can't. In theory, you can. Now, the second one of the confidential, not transparent. I'm not trying to take a moralistic view of private do it or not. I was in government in Costa Rica. You cannot not disclose sovereign lending, because we have a process that it has to be approved by parliament. I was talking with someone from Ecuador. I was shocked. They can write a non-disclosure agreement on sovereign debt. And so it's at that level. The world is full of shades of gray, but this one is a little bit in your face. And so that is what we're trying to think on that.
We have time for one last question. Gong Chang.
Thank you, Sebastian, and also thank you very much, Laura, for your presentation. Very interesting. So just one point, I mean, more for thoughts and also future research. So you mentioned this time difference in terms of re-access to markets. I think as regarded China, there are two things which could probably explain this phenomenon, but which needs further exploration. One is there is a diversity of Chinese lenders, right? I mean, especially in some cases, they are Chinese state-owned enterprises. They finance the projects, and then if things, in some cases when things went sour, they could still find alternative financing from other lending institutions. So here, China has a multiple dimensions in terms of who is lending money. So there might be a series of lenders that are in different phases, and they can provide financing. I think this is one aspect related to this multiplicity of Chinese lenders. And the second point is maybe related to the nature of financing. Because if we compare now and then, like brandy bond period, so there is a lot more project-based financing for particular infrastructure. So some big infrastructure projects actually, they might end up, so the financing part may end up in debt restructuring or distress, but new money could be required or sought from other sources for those projects to continue. So there are certain like counter cases which tell us about this kind of operation. So I don't know to what extent project financing has also changed the nature of the lending behaviors from credit countries. Thank you.
So again, this is why, as I said, we're not as smart as other people. And so we had to start like little by little, because you're opening the can of worms, not only, as I said, there are different assets and different players. And one start thinking about this, it gets very complicated. But you're right, that there are just many moving parts. And so right now we're thinking of just like one bond for consumption. There's a bigger that modeling investment in this literature is tricky. And so that's just a technical and not really good excuse, but there is a technicality issue associated with it. But a bigger question, and I think that has emerged from this, is what do we target? Can we come up with a X number of countries that we think are examples for the rest? Or do we need to go one by one, the Angola, the Chad, and with all these idiosyncrasies that are complex? The literature has taken this very crude approach. They have chosen one country and decided matches everyone. With China, it becomes tricky because Argentina is very different from Angola and is very different from Gabon. And so we first started with Angola. Now we're trying to think of a more general number of countries because it just feels unsatisfactory just to take a couple. But once you go that route, you also start going into all these little details that people have been mentioning. But I do appreciate the comments, and if anyone has other suggestions, I just saw Carmen posted a paper that has been defaulting to the IMF. Please let us know.
Thank you again, Laura. Very interesting, and thank you to for all the comments. There's a lot to discuss. There are actually two more questions also by the broader audience, Laura, in case you want to respond to them in writing. With an eye to time, I suggest we move on to Aitor's presentation and then resume the discussion. Aitor will present the paper on debt relief games.
Many thanks to the organizers for setting up this event, and even more for having our very preliminary work being part of it. So we just listened a very nice paper with plenty of facts about like the ways that lenders compete for, say, maybe seniority or capacity to repay when lending to sovereigns, and how there have been all kind of legal and financial innovations, stuff like collateralization in order to basically achieve seniority over other creditors. In this paper of us, this is that I'm going to present today, is called Debt Relief Games. It's joint work with Gong Chen, who's with us today. We are kind of looking at a complementary question from an empirical perspective. Like we are interested in using the historical record of the restructuring with different types of creditors to understand how creditors do combine, coordinate, or I mean, how is exit from default when default involves a variety of different creditors. So because Gong is working with a Bank for International Settlements, we have a disclaimer. So anything that I'm going to be saying is just our very preliminary view. So motivation, I think, like following Laura's talk, there's very little for it, but maybe bringing some aspects of why coordination is so important nowadays. So we are seeing, like, following the COVID crisis, the G20 came up with this thing. It's called the Common Framework for Debt Restructuring for Low-Income Countries, that is intended to facilitate coordination in debt restructuring when countries they face a situation of default and they have a variety of creditors, as has been explained, traditional official creditors, Paris Club, China, India, the other official non-traditional creditors, but also all kinds of market agents, or even in some cases, domestic creditors. So actually, this G20 Common Framework, I think there are like 4 or 5 countries currently under the framework attempting to achieve debt restructuring. None has managed yet, despite this has been going on for over 2 years. And this just speaks highly about how important it is to have some mechanism to achieve a successful coordination on burden sharing to facilitate the speedy resolution of sovereign default. So the way that this was supposed to work in practice in this common framework was by transposing another of these key principles that has been guiding Paris Club operations historically. This is the comparability of treatment principle, which basically says that if the official creditors part of the G20 achieve or reach the restructuring agreement with the country should strive to obtain similar debt relief from any other private and official creditors that have not participated in the agreement with the framework. This framework has been set, and repeating what Laura has very nicely explained, has been set in an environment in which coordination is increasingly hard to achieve. Earlier in the 80s, because most of the financing to poor countries was coming from Western entities, either official or private, during the 80s, coordination was achieved when it was achieved through pressures applied by the public sector and the private sector, and this is well documented. But from the 90s, with the appearance of bondholders, with the appearance of commodity traders, then with the appearance of non-Paris Club official creditors, some of which appear to have a preference for a bilateral approach to debt restructuring, coordination has become very hard. So this is a statement from last week, was like the 10th annual conference, the Paris Club, and the focus of the conference this year was precisely how to achieve coordination among different creditors in a challenging environment. So it's just to show like the very pressing relevance of the issue of coordination among creditors during the restructuring. So with that kind of background in mind, so what we do, so as I just said, we get historical data on the restructuring, so in the restructuring, and we come up with what we think is a new, different way to examine this historical record by constructing what we call the relief gains, which are basically indicators of de facto coordination or coincidence in the provision of the restructuring. So we define these gains so that, looking at the time series, I'm going to give specific examples down the road. When a creditor we think that we can look at the series of debt relief over time, and then like see when a creditor initiates a gain because he's providing an amount of debt relief to a country as according to the databases, and then we can check whether this provision of debt relief is followed or not by the provision of debt relief by other creditors. So following this approach, we can build indicators of leadership. So we can figure out who are the leaders, we can figure out where they follow, we can identify them, we can actually define successful and failed leadership as leadership that actually triggers a reaction by someone or not thinking so much about whether this has positive macro implications, just about like the mechanics of like different creditors come up together to provide their relief. And once that we filter the data through those game-based lenses, we use that recategorization of the history of the restructuring to study a range of issues you are going to see the presentation is very exploratory. We can look at many things, so we are still a bit undecided and like looking in many directions. So hopefully you will help. But we can look at things. So what does the historical record tell us about coordination? Does it support de facto coordination? So do different creditors come together to provide the relief? If that happens, who's the leader? When do they lead? So these are things we could answer. We can try to answer. We can also study whether the amount of debt that is being restructured and the terms that are offered to debtors, they depend on these games that we are setting up. Do they depend on who is the leader and who are the followers during these episodes of coordinated debt relief? And then we can also like consider whether this actually matters at all, right? Because I mean, like we have come to claim that coordination among creditors is key, but I think that this is mostly construct of like looking at the specific cases and considering that we have some good examples in which things work. Maybe the HIPIC, and this is something that is going to come back here, but so does coordination matter? Does it have an effect on macroeconomic outcomes? So these are questions we can try to answer, and what is left, I'm gonna present the first pass at answering some of these questions very simply. Okay, so let me describe a little bit what is this data that we have put together. So like along the lines of most of the narratives of the current problems with the international mechanism for debt restructuring, or the framework that we have available, we have put together information on sovereign debt restructuring for 3 types of creditors. The Paris Club, and for this, we use some work that did myself with Javier Diaz-Casó and Gong. So we have updated that data set. So we have a Paris Club debt restructuring, information on volumes, type of restructuring, and PV losses. Then we use the restructuring with private sector creditors, and we of course use the work of Christophe and Tamon. We updated it because the last available data set they have doesn't cover all the cases we wanted to cover. And then we have China, and here we are combining different databases, one of which was prepared by Gong. We stopped the data collection in 2019 because we wanted to leave outside the analysis the DSSI and the common framework. We just want to look at this historical record and take lessons from that period for what is coming next, which is actually the common framework. So in addition to this, the restructuring data, we collected data on different macroeconomic variables and indicators from the WE or the World Bank, and some historical IMF historical archives to complement some series. And then what we did with our time series, our indicators of restructuring. So for each creditor type, the first thing that we did is bundling debt restructuring events, or like the debt restructurings that were annotated within each of these 3 databases that fall very close in time. We following also some work by Carmen and co-authors, we decided that these restructuring events that fall very close in time are to be considered as one episode. We do this using a mechanical rule of 18 months. Results do not change that much if we use alternative rules like a 24-month rule. And this helps us avoid an overestimation of coordination. By like, if we spread the windows enough, we are always more and more likely to find that some other creditor has provided relief to this country, but that doesn't necessarily mean coordination or like even coincidence if we spread too much the window. So we went for a maximum window of 2 years. That was giving us similar results to the 18 months, so we kept the 18 months. Then like when we aggregate these different events or like these different episodes into this kind of joint episode, for those characteristics that require weighting, we use the volumes of debt involved as the weights. And in the next step, what we do is like once that we have built this, we have redesigned our 3 series of debt relief for the 3 types of creditors. we bundle these different episodes into what we call debt relief games. So we consider the actions of other creditors. So every time that we see one creditor giving debt relief, we start looking at the other creditors. We allow 18 months to pass. In this case, we use a 14-month rule, but the results are robust to an 18-month rule. So it's a type on the slide. So we allow 24 months pass, and if we find that some other different creditor is also providing relief, we have a game in which we have a leader and then we have a follower. Next slide is providing an example with a timeline that will make more apparent how we are transforming the data. Okay, so the slide provides for an example of an hypothetical country in which when we look at the three databases, we have 6 different events. Okay, so like the country started by restructuring with the Paris Club in January 88, then in July 88, then there is the restructuring with the private sector in November 88, then another one with the Paris Club in February 92, and then there is stuff with China, one in May 2001, and the history of this country in this example closes with another one on January 2002. Okay, so first we look within each of the 3 databases, and for the case, you see, for the case of the Paris Club, we have these 2, the restructurings by the Paris Club, that are very close in time. They are like 7 months close, so smaller than our 18 window. So these 2 events, they become one episode in this updated database. Then we see that there is restructuring with the private sector in 1988. This is within a 24-month window that we have set to determine that the Paris Club has started the game and it has found a follower, okay, which is the private sector. Then we move forward, February 1992, nothing happens. So this, for us, is a game in which, like, the Paris Club opened the game, but the Paris Club found no follower. And then we have a last game coming out from these 6 events. That is the one that comes from, like, China provides relief in May 2001. So China becomes the leader of this game, and this is a game in which China finds a follower because in January 2002, so within the 24-month window that we have set, there was a debt restructuring by the private sector. Okay. So when we apply all these kind of changes, what happens is summarized in this table and further summarized in the few sentences on the bottom of the slide. So if one thinks about the change from events to from events of default to default episodes, so how we bundle together information within each of these historical databases. For the case of the Paris Club, we bundle into another event almost 100 events, a little less than 50 for the private sector, similar for China. And when we further bundle all of these different default episodes into debt relief games, which achieve coordination or not, we go from a total number of 653 episodes of default to over 500 episodes, or to over 521 debt relief games. Okay, so because we can then, like, just take the characteristics of all the treatments that are associated with these different games, we can start providing summary statistics or some numbers about how these different games look. So first, one example on how to use this partition of the restructuring histories into games. Here we depict the Paris Club acting over time. So blue color there is highlighting every time that the Paris Club provided debt relief and no other creditor provided debt relief in a certain window. Green and purple colors refer episodes in which the Paris Club was met afterwards by relief by some other type of creditors, and unread the lesser instances in which the Paris Club actually entered into the debt relief game as a follower. Another way to look at the data is to make breakdowns of episodes and consider who are the followers of the different leaders in different decades or in different periods. So in this slide, again, like looking at the Paris Club, that evidently emerges as like the major player in these debt restructuring games. So this graph show that in our sample, for the first 2 decades, the 70s and the 80s, the debt relief game was literally a game that was played on its own by the Paris Club. Right? Then entered the 90s, entered the 2000s, and there is an increase in the relevance of the private sector, and then on the relevance of China as a follower of the Paris Club in these debt relief games. We can also consider whether achieving coordination, defining coordination as the time it passes from the first type of lender providing relief to the last lender within the game providing relief. One sees that there is not a substantial difference in the length of coordination, but in any case, in most of the cases, the coordination is achieved in less than a year. And there is only one instance in which coordination appears to be very close to the bounds that we have set. That is when we look at how the private sector as a leader is able to meet with China as a follower. That happens very, very close to the window that we have set. But for the rest, it doesn't really seem that who leads or who follows is really affecting how long it takes to achieve coordination, if coordination is achieved. And we are talking about a year time. Now, interestingly, even if maybe not unexpectedly, longer time to coordinate doesn't buy more debt relief. Okay, so we actually find that the correlation is, for the latest period, the correlation between the length of time of this game and the amount of debt relief that countries obtain in MPP terms as percentage of GDP is almost literally zero. Another thing that we can do is we can check the extent to which the terms that different creditors, different types of creditors decided to provide when playing the game coincide or not, right? So one way in which we try to exemplify that is through the use of correlations. And this is what we are showing here. So the first table above is showing the correlation in the amount of debt treated over GDP between different types of creditors, depending on whether they are leaders or followers in the game. And we report these numbers for the full sample, but also for the sample that starts in 2000, because that's the sample where China is actually playing a more relevant role. So the red numbers, they go for negative correlations. The green numbers, they go for positive correlations. So we kind of like to extract a message from this table, even if these are just like raw correlations. We haven't run tests on them, not yet, but we like to, I mean, we like this comparison of the green in one side and the red on the other, because we can translate it in something that maybe we understand, because it resembles what's going on these days. So these red numbers mean that the more debt the leader of the game is treating, the less debt followers are offering. Right? So this is talking about competition for the debt perimeter. So what debt should be restructured? Right? And we see that this kind of competition for not adding debt to the restructurable debt lot bites everyone at any time, at any point in time. But then we also find, and these are the green numbers there, and like we sort of like when we saw this, that there is emulation among creditors in the provision of nominal debt relief, because what this table is providing is the correlation between the amount of nominal or principal haircuts, nominal debt that was canceled to GDP, the correlation between the nominal debt relief provided by first movers and followers for different types. And what you see there is that this is mostly on the green. What this is telling us is that the larger the amount of face value reductions that the Paris Club has done historically, the larger the amount of face value reduction that both private creditors and China have provided afterwards. But the table is telling us something more. It's also telling us that apparently in the recent period, when China has led and has provided nominal debt relief, the larger this has been, the larger the nominal debt relief provided also by the Paris Club. Okay, so this provides some hint at some sort of coordination in the provision of nominal debt relief, historically, and in a direction that is not the standard one from the Paris Club to the rest, to the comparability of treatment. Further looking into, how the gains may affect the outcome of restructuring, only for the private sector and the Paris Club, for which we have the numbers and we have values for NPV losses on the restructurings. We also look at these correlations, and what we find is very, very strong emulation, as probably the COT would indicate should happen. So for the period starting in the 2000s, you see the correlation between the private sector and the Paris Club is really, really large, especially large when the Paris Club is the leader, as again the COT would seem to impose. Then we started to think, like, okay, so what drives coordination? So we came up with this one thing we wanted to solve. There is a simple way to look at our history of games. So we take world growth, right? And we, over this period of our sample, we just break down world growth in three buckets, right? Like 30% observations with lowest growth, 40% with middle growth, and the 30% observations with largest growth, right? And that then, like, we kind of wonder, like, so does world growth have some kind of impact on coordination per se? Looking at the ratio of instances in which we see coordination, or games in which there is coordination, and instances in which some creditor provided relief without finding any other creditor providing additional relief, so uncoordinated the relief, there doesn't seem to be that much of a difference. But actually, when one starts looking, and that's what we do in the next table, the characteristics of what is being provided through coordination, what one can find is that there is a very substantial difference in the amount of debt relief that is provided when the economy is booming and when the world economy is not in its best shape. This can be seen in the last column of this second table, right? So NPV haircuts to GDP when the world growth is low are of about 8%, when world growth is at its best, is doubling. The last table there shows, and this is, we will need to do further work, but we just wanted to show this table that shows that even the correlation between the different characteristics of the restructurings during episodes of coordination are affected by the macroeconomic situation, by the global situation. Listening to Carmen's comments to the previous presentation, I came to think that probably the number of crises in a single year should be another potentially useful way of breaking down all our games to just understand whether like maybe coordination or the willingness to provide relief is higher when there are not that many games to play. So all this goes for stylized facts that we can bring out from combining all these debt restructuring episodes into debt relief games. Then like final set of results that I wanted to show. They bring some econometrics in, right? So we try to answer, this is the first pass at trying to answer this question of like, does this really matter? So is coordination good for something? Right? Or the way we measure coordination, at least, does this have any kind of macroeconomic implications? So we try to explore that using this very simple regression framework, in which we are looking at what is the impact of either coordinated debt relief or uncoordinated debt relief on a number of variables. Most importantly, like the ones I'm going to focus my words are like the effect on GDP growth and the effect on the debt stocks. Right? Like we are adding a number of variables. We add country fixed effects in some regressions, also time fixed effects. And in this regression, the variables of the coefficients of interest are the betas, beta C and beta U. And these coefficients, they can measure either the effect of an event if we are using dummies that reflect whether we are in a coordinated relief event or in an uncoordinated relief event, but they can also measure the effect of continuous variables. And given that we have the volumes of debt relief provided, so in this presentation, we are going to be presenting results in which coordinated debt relief and uncoordinated debt relief are measuring the volume of debt that is being restructured as part of the corresponding games. So this is what we get when we regress on our full sample. We find no effect on growth, very significant and strong impact on debt. So apparently, as one would expect, both types of debt restructuring are capable of reducing the stocks. The effect is stronger when the restructuring comes in a coordinated manner. There is also an important effect, a significant effect on the primary balance. In both type of cases, primary balance seems to increase. This is more clearly the case when we talk about coordinated debt restructuring, as shown by the precision of the estimate. Now, then we run the same exercise, but for the post-2000 sample, where the results are better reflecting the fact that China is part of the sample and Chinese debt restructuring is better represented in this subsample. So when we look at this subsample, we find some different results. In particular, we start to find significant effect of debt restructuring on growth, particularly strong in the case of debt relief under coordination. Right? And again, what I mean here is that the precision with which we estimate this coefficient is very large. Again, we find that both types of debt restructuring are capable of reducing the stocks, and both trigger an improvement on the primary balance. When we start, we have run a number of experiments in which we unbundle our dummies for coordination. So in this exercise, in which we present the results for our post-2000 sample, we look at whether these coordinated and uncoordinated the restructurings, whether who leads is important. And our results appear to indicate that from the perspective of growth, having the Paris Club as a leader has historically been a recipe for better growth, no matter whether this happened in a coordinated or an uncoordinated manner. One result that we found that is relatively surprising, also given the narrative, and also it's something we need to for sure check more, because like estimates for China are not pinned down on that like as a leader in the restructuring are not pinned down on that many gains, but we find a very strong effect, an improving effect by reducing debt of having debt restructuring in which there has been coordination and China has acted as a leader. I think this is the last regression result I have here. What we've done is okay. So maybe what matters is that coordination happens, or that there is a framework that clearly tells us what we need to do and what every actor needs to do. And we think that like the prime time example of that kind of framework is the HIPIC. Right? So here what we do is we get our indicators for coordinated debt relief and uncoordinated debt relief, and we separate them according to whether that coordinated debt relief or uncoordinated debt relief was part of the HIPIC initiative or was of any other type. And what we find is, from a growth perspective, any positive effect that one can find has to do with the HIPIC initiative. It is not that important that there was different creditors, but appears to be very important to have a framework that clearly defines how to provide debt relief. And from the perspective of reducing the debt, once again, coordination again appears to be successful in reducing debt relief. This result is pretty weak, though, in the presence of a clear framework for the provision of this debt relief, like the HIPIC initiative. Okay. So those were the results, that many very preliminary results we wanted to show. So these are the main takeaways. So very shortly, we look a little bit at how different creditors play the debt relief games. We see that successful coordination is mostly led by the Paris Club. We also saw that taking a long time to manage to convince different types of creditors to provide debt relief doesn't necessarily imply that you're going to get, or that more debt relief is going to be coming out from the whole exercise. We find strong evidence of coordination of private creditors with the Paris Club, but not with China. It's very tight for NPV debt relief. But we also find that China is often providing debt relief following the Paris Club, even if it appears to have a preference for restructuring alone. And then finally, we just showed some very preliminary econometric work to show that coordination can have important macroeconomic implications. And that would be it. That would be the presentation. Thanks.
Thank you very much, Aitor. Very interesting. I suggest we open it up to question. We're a tiny bit over time, but we have the break as a buffer. So please come in. Please raise your hand if you want to comment or ask a question. I see Carmen has your hand up.
Very quickly, I think this is great work. We have dire need and a big gap on the modalities of restructuring games and debt resolution. So in your entire analysis, though, and this is, I think, a suggestion to add. You're thinking of a prototype restructuring process, and that prototype can change over time and so on. But let me suggest two prototypes: more of a low-income, non-systemic country versus a higher income, more systemically impactful. By systemic, I mean, the old story, if you owe the bank a little money, and you can't pay, you have a problem. If you owe them a lot of money and you can't pay, they have a problem. And so the idea of speed and who moves first, and just anecdotally, I mean, you see that, I mean, the Brady plan was no bargain in terms of how long it took to come around. I mean, since Mexico's 82 default, but my God, the HIPC took even longer. And in the work that Sebastian will be presenting, our recent work, we also show that the way China deals with some of the low-income countries is not quite the same as the middle-income countries where exposure is higher. So think of two prototypes, but I really think this is great stuff.
I think it's a good suggestion. What can I say? It makes perfect sense.
There's another one by Christoph.
Yeah, hi, Aitor. Thanks a lot. I was wondering, so we have, so you use the restructuring date as kind of the key factor, right? In this. I was wondering, so I think there is a dire need to understand somewhat better when the negotiations with like non-private. I mean, I know I'm asking for something impossible, but since you look into these games, then of course, I don't know if there's any way via Factiva or some other source to identify when negotiations start with these other players like the Paris Club. Maybe or I mean, I know it's not possible for your 1,000 restructurings or something. That's impossible. It's going to take you years, but maybe it's possible to do for just a couple of maybe recent cases, say the last 10 years, where more information has probably leaked on, say, Common Framework, Paris Club, HIPC, MDRI, all these initiatives that got a bit more, basically the Paris Club being pressed into more transparency. And same with China, where now we know more from various narratives, etc. So I'm saying this because, of course, to understand the sequencing, the leader, the follower, it's crucial to understand when they start, right? I mean, this is not to say that what you do doesn't make sense. On the contrary, I think, ultimately it's, do you make the deal or do you don't, right? I think the basic approach makes sense, but I think still to learn about the game, I think it will be very valuable to kind of identify patterns of delay. And I think, we know so much about delay for the privates now. There's been all this work. We know so little about delay in other restructurings. I think your paper could be a very nice kind of citation or source to at least get some anecdotal evidence on delays for these other creditors. That would be my suggestion. I know it's a lot of work, but I think that would be really cool to understand the processes. And you've looked into all these, all three creditor types, so you're kind of also pretty well set up to do that kind of analysis.
Yeah. I mean, so I see the value, right? I mean, that is the negotiation process with different creditors that maybe is being affected even by the negotiation process with other creditors. I mean, unfortunately, and I think we discussed about this, also because of the nature of the Paris Club and the multi-country negotiations. I mean, you really would need to probably go and keep track for every single Paris Club treatment. You're going to have 25 signatories. You're going to have to the national whatever sources of information to see whether the US started negotiation before France or before the UK. We chose to just pick these dates because they are really well set. And for example, for stuff like the comparability of treatment, I mean, it may matter for the macro effects. That's why, we've been working with our measures of duration, trying to put them in the regressions. We are still trying to figure out what is all these numbers we get, because it's not very clear that maybe in part the problem is that we have we chop the history of the game from the moment in which like one of the players has already agreed to provide relief, but the game starts with the negotiation, right? So I completely agree with all of that. But at the very least, we can hold this date in which, okay, debt relief has been provided. Now what? The one thing that we are in train of doing is being able to tease out from the non-coordination situations in which there was no coordination because there was no need for it. Meaning, right? So a country in the 80s that basically only has debt with the Paris Club. What the hell is going to be restructuring with the private sector of China? I mean, if the debt structure is official, I mean, there is no, I mean, like we are calling that a missed coordination, but we know it's not because we don't really have this information. I mean, we still have not filtered in this information on the structure. Once that we do that, I think that looking at the moment that the agreement is achieved and look for the next agreement in time, that distance is valuable on its own right, even if that distance may be affected by something that we don't know, which is when they started. Right. But this, of course, and we can see that from the dynamics now, that is, I mean, I don't know what to figure out when they started, right? I mean, like because I mean, it's all gonna be measurement error, right? Like you're gonna use, I don't know, Reuters, Red, you pick your favorite news outlet, right? It's delayed, right? It depends on, I mean, how good my connections, how good, what do I know? I mean, it depends on like, see, I mean, it's not something that should be known. And this goes back to all this issue of the lack of transparency and the confidentiality. I mean, like all these Paris Club treatments, they have confidentiality, right? I mean, like there is a bare, and then it goes on top because, you know, well, man, there is a bare minimum that needs to be agreed. And that is what is the bare minimum. But countries, each country that is a signatory of the Paris Club treatment is signing an individual agreement. And that individual agreement can easily and very often does provide extra debt relief for political reasons, for social reasons, for whatever.
And often signed with delay.
Yeah, then I mean, like, listen, it's like, should I start thinking like, okay, Spain with Argentina, there was trade credit, there were the bank, like every agency, like very much like in China, that now is on, you have very different agencies. They speak their own voice, but in the 80s, this was happening for Western countries, right? That's why we set up all this architecture, precisely because we were facing that same problem. So, I mean, like maybe, I mean, like if we get like some super cool artificial intelligence thing that can read everything very smartly, then fine. Otherwise, it's a pain in the ass. You die, right, to understand these things, you know, well. But
thank you very much, Aitor. This has been very interesting. Thank you also, Christoph Garvin, for comments and discussions. We're just 5 minutes over time. I suggest we take the break and then reconvene at 4 p.m. Central European Time, 10 a.m. Eastern Standard Time, so for the second session of the day. Thank you very much.
Thanks.
Okay, welcome back, everybody. This is the fourth and final session of our workshop. We're looking forward to two presentations, one by Andreas Fuchs and co-authors on the question of whether Chinese aid buys foreign public support, an intricate and important question. And then we'll finish with the paper by Sebastian Horn and co-authors, including Carmen and me and Brad, on China as an international lender of last resort. All right, so I'll hand over to Andreas. Thanks a lot for participating and joining us here.
Okay, yeah. Thanks a lot, Christoph, Sebastian, Carmen, yeah, for bringing us together, for organizing this conference. It's also a big pleasure to present our work can aid by foreign public support evidence from Chinese development finance. So this is joint work with Lukas Wellner also from Göttingen, Axel Trier from Heidelberg University, Brett Parks from William and Mary, 8Data, and Austin Strange from the University of Hong Kong. So here on the first slide, you'll find two pictures of Chinese aid and investment projects in the Global South. And I think in this conference, I do not need to highlight that China is now the world's largest bilateral source of international development finance. But what I would like to highlight is that China spends considerable amount of time and money disseminating positive messages about its generosity to the populations in recipient countries and countries receiving Chinese development finance. So they attach their logos to aid shipments, as you can see on the left picture. They place signature at project sites, like here the stadium constructions on the right. So in short, development finance by China is clearly used to shape perceptions on the ground in developing countries. But the big question that we try to address in our paper is whether this is indeed working. So whether China affects attitudes towards itself, towards its leadership. So whether Chinese development finance is an effective soft power tool. And they are not just the projects itself. There's also a campaign surrounding it. So like social media, here like a video on the Belt and Road Initiative to highlight the supposed benefits of these development finance projects on the ground. This question is of growing importance. And I think in these geopolitical heated times, it's easy to see. So the United States, China, they compete for favorable perceptions in global public opinion. So what I brought here, so the average support for the Chinese government by world region over time in the data I'll introduce later. And I think there are two interesting features. So first, support for the Chinese leadership is strongest in sub-Saharan Africa, which is one of the target regions of Chinese development finance, as you can see on the top with a dashed blue line. But you also see from this figure that global support is a challenge for China. And I think we can observe a decreasing trend in the average support for the Chinese leadership. So why should we care as economists about public image? So first, from an economic point of view, we know from the literature that trade and investment increase with bilateral trust and affinity. So like in the Giso Sapienza Singales paper, QJE, they highlight that yes, if you manage to improve trust in your country, this will pay off in terms of trade deals and investment flows. Then there's also evidence for political consumerism. There's evidence that boycotts can be effective, and also work that soft power itself can positively influence your exports. Then in 2023, of course, as economists, we care also about the political effects. So we also know from the literature that positive opinions can help build closer cooperation also in non-economic dimensions, such as foreign policy. So these development finance projects are seen as a vehicle for public diplomacy. So our paper is part on the broader literature on the effectiveness of development finance. In particular, there's a lot of work on aid effectiveness, on the effects on growth, income, health. Overall, the evidence is mixed, but also if you expect that development projects affect soft power, that doesn't they do not really need to be effective in terms of generating income. Of course, this is likely one of the possible mechanisms, which we will also test later, but it could also work via a donor country like China takes care of us, they give us attention, or maybe also hope that the economy will improve in the future. So we build on this literature, but with another outcome variable that is much less explored in the literature, which is soft power. So we check whether Chinese aid and loans is effective in improving opinions on the Chinese leadership. Yeah, to be a bit more precise, here I picked one of the projects in our data sets, which is the Manda-Luvinga Road project in Zambia. So yeah, what do we know about this project? We know, of course, when has it taken place, and we will exploit a particular feature that we also know the precise geographic location of all these projects, and also we improved the data and now have a much better coverage of the exact days when a project was committed, when it started, and when it was completed, to estimate then whether there are visible soft power effects. Yes, maybe not the map. So how do we expect these projects to play a role? Not just the possible benefits to the population, we also expect that there might be already effects much earlier at the time of commitment or when the project started, because these events are typically accompanied by ceremonies, ground laying work, often when the projects are opened up, like here in the Manda-Luvinga Road project, the Chinese ambassador comes, so there's a lot of media coverage in a newspaper, in social media, and often also the president of the respective country joins, like it was also here in Zambia. So our contribution, so we analyze this question whether development finance is an effective soft power tool on a worldwide scale. So we are not the first to analyze it, but we have global data on Chinese aid and loan projects. And we combine it with survey data from the Gallup World Poll on the approval of the Chinese leadership. And what's also special about our analysis is that we look at several layers of potential soft power effects. So first, we start at the local level and analyze the attitudes of the people living in the provinces where a project takes place. And then we move from one level up to the entire country. So people, including people living in other areas where there's less direct exposure, but we expect significant media coverage. So we also test whether the entire country is affected. Finally, we don't stop there. We go even one further layer up and look at the international audience, because if we want to assess the soft power effects by these activities, Chinese activities, we probably care about the net effects. So for example, assume that a particular development finance project is well received in particular countries, say in Pakistan, which is one of the most important recipients of Chinese aid and investment projects. Then the same project, if it's covered in neighboring India, might have negative effect on Chinese government approval. So which is why we believe this third highest layer is also important. So we look at the global effects, but also we look at specific country groups where we believe that China cares most about its soft power. So for example, those countries where it already has a good or a very bad standing, but also, for example, those countries that are somehow in between the West, the US, and China for expressed by voting behavior in international organizations. Okay, the other contributions are this use of microdata. We have information on 1.5 million respondents and allocate that to the province level, so the first subnational administrative units. And then we improve the existing Chinese development finance data from aid data and collect additional information on project commitment start and end dates. So we proceed in 2 steps. So first, we analyze the short-term soft power effects and then the longer-term soft power effects. So we measure causal effects of Chinese development projects in the short and longer run. So we start with time-stamped respondent level data for more than 1.5 million people from the Gallup World Poll and use it in an event study. And we have precise dates that allow us to compare respondents right before a new Chinese project commitment, project start, or project completion with those interviewed after. And we don't believe that, if they just interviewed a couple of days early, before or after that, this should be random. So we believe that we can identify plausible causal effect in the short run. But so on the one hand, this discontinuity makes it easier to identify causal effects, but there's an obvious advantage. Also from a policy perspective, of course, we also care about the longer run effect, which is why we also aggregate the data to the national level and look at longer run effects in an instrumental variable approach that I will explain to you in a couple of minutes. So overall, we find positive effects at the country level, in the countries that receive Chinese development projects. This effect is lower relative to the country level in the provinces where these projects actually are carried out. At the global level, we cannot observe visible net effects, but if we then look at subgroups of countries, we find in certain subgroups of countries where China arguably cares most about, like Africa, like those countries that are sort of swing states between the West and China in international organizations. There we find also effects that promote China's soft power, so the approval of the Chinese government. Yeah, so this was the overview. So now let's jump into the data. So we combine aid data's global Chinese official finance data. So 3,500 projects with Gallup World Poll data, so the individual level data. So we improve the Chinese official finance data with additional information on commitment start and end dates, because there are many missings in the original data in order to identify causal effects in the short run. So maybe just to show you how this looks like. So these are the number of completed projects by province according to aid data. And these includes those projects that could be both geocoded and where we also were able to gather information on the exact event dates, so commitment start and or end. Then Gallup World Poll data, so covers the whole world. We use the part that covers developing and emerging countries. So covers the years 2006 to 2018. And we use mainly this specific question: do you approve of the job performance of the leadership of China, as our main outcome variable? In the paper, we also look at 2 alternatives. So the good thing about Gallup World Poll data is that we know the exact interview date, and we also know in which province the interviewed person lives, and this allows us to apply our causal identification approach. So I think here the map is actually quite interesting. So again, it's approval of the job performance of the Chinese leadership. So in red, you observe, red and orange, you observe the parts of the world where there's least support of the Chinese leadership. And I think it's not really surprising that there's, for example, in India, it's quite low. And then also we have in blue or green, those parts of the world where there's strong support of the Chinese leadership. And these are many countries, for example, in sub-Saharan Africa. Okay, so now this was on our data. Now let's move to the short-term effects with our event study approach. So the Gallup World Poll interviews each country each year. And typically it's roughly a 4-week window in which interviews take place. And obviously these survey waves also coincide with our project events of Chinese development finance projects. So we take all those projects where we have this overlap. We argue that the timing of the survey relative to the project event is random. So whether a person is interviewed just a couple of days before or after project start or project end, this should be random, and it's also unlikely there are any systematic effects like other events happening at the same time. So we can look at the opinion on the Chinese government just before and after project events and compare the individual. So typically it's just 4 weeks, but in few cases these windows are longer, and then we will compare individuals only 1 month before or after the event to make sure that there are not too many other things happening at the same time. And we use high dimensional fixed effects to control for confounding factors, as you can see on the next slide. So we estimate the support for the Chinese government. We have a post indicator that indicates if the interview occurred before or after the project event itself. The typical individual level controls like gender, age, education, and an urban dummy. We have also survey level control. So for example, we control for the weekday. So maybe individuals are more positive on the weekend and more likely to express more positive attitudes or whatever you might imagine. So we want to rule out that our results are driven not by those survey characteristics. And then most important, our high dimensional fixed effects. So we have province year fixed effects. So we keep each province, so first subnational administrative unit, constant, and the year. So it's only variation within province years. And as I said, we restrict the sample to 30 days before and after the event in those cases where the survey window is longer, but in most cases it's much longer. Okay, here are already the results for the short-term effects. And here we find, if we look at all project events, so commitment, start and end, we find no statistically significant effect. But if we focus only on the end date, so when projects are completed, like the Exim Bank financed road has been opened up, or the China Development financed railway, then we find positive and statistically significant effects. So only weakly significant, but we also look at aid specifically, so at official development finance, and then the effects become stronger. And we also look at large projects that are more expensive than I think we had only one. So I forgot the threshold, to be honest. I think I would need to look it up, but I think it's 1 million, so it's really low, but just to make sure that these are significant projects, and then also the effects become stronger as one would expect. Yeah, and we also, this is at the country level, we also have separate regressions at the province level, but it doesn't seem that the effects are stronger at the province level, at least when we look at start and end dates. So intermediate conclusion is, yes, there seems to be a short-term effect of Chinese development projects on the approval of the Chinese leadership in this arguably causal event study. But obviously, we also care about the longer run effects, which is why we also run the instrumental variable approach. So in case you're interested in the Q&A, we can look at the specific projects that are in the window. We check whether the projects that fall into the survey window are representative. We looked at pre-trends, also have randomization where we vary the project dates in the survey window and observe that it's unlikely that we obtain the significant positive effects just by chance. Okay, alternative bandwidth. So if you, in the baseline, we look at 30 days before and after the event, and it seems to be robust to that. And we also look at different clustering of our standard errors. But let's move to the longer term effects. And here we apply an instrumental variable approach that we have already had used in a paper on Chinese aid on growth. And this is an interacted instrument that exploits the property that China provides significantly more development finance when it overproduces raw materials like steel, iron, wood, cement. So we look at 6 timber, I forgot, glass, aluminium. This has been shown that this increases Chinese foreign aid because China cannot sell it on the domestic market, and then they dump it overseas in the form of foreign aid or loans by the big projects financed by loans by the big policy banks. So obviously this variable only varies over time. So we interacted with a variable measuring the probability of receiving development projects for each province in our data set. So the assumption is that we get a differential effect of surplus project inputs on public opinion and compare provinces with high versus low probability of receiving Chinese development projects. So this is the first stage with the interacted instrument. So this overproduction of raw materials that we obtain by taking the first factor of these 6 production series of these 6 important input goods. And then this probability to receive aid, that's our instrument. And then the second stage, we again estimate the opinion on the Chinese leadership, but now aggregated either to the province level or to the country level. So we again control for the individual level characteristics, control for province fixed effects and country year fixed effects. So these are our results. So let me start with the country level results. So in the country level results are in line with what we saw for the short-term effects. So we again find a significant and large, I will tell you a bit more about the size later, significant and large positive effect of Chinese development projects on the attitudes of ordinary people towards the Chinese leadership. So this is already visible when we just look at the conditional correlation with an OLS, and also when we apply our 2SLS approach with the instrument I've just shown you. The effect appears to be less pronounced in the province that is targeted. So this needs to be interpreted as relative to the country level effects. So this doesn't mean that there are overall negative effects, because we include country year fixed effects. And finally, when we move the layer up to the world level, there's no average effect left. So it appears that the net effect is not measurable, at least. So this is okay. This maybe the, yeah, I think we can, maybe due to the time is running up. So maybe let's move to the mechanism, which I think is probably more interesting. So how does this work? So we have several hypotheses. So first we tested the typical aid effectiveness channel. So Chinese development finance actually managed to improve the income of the average person on the ground. So this we checked, and we indeed observed, so let's focus on the country level for time reasons. So we indeed observed significant and positive effect on income, also on perceived income, also on the living standard. So the share of people that report that their living standard is good. We also checked for the public goods channel, and there's an index in Gallup World Polls with on satisfaction with community basics, and we also find a significant positive effect there. And finally, as there's a lot of evidence and rumors, but also systematic evidence that highlights that Chinese development projects were to increase corruption, or at least perceived corruption. We also checked this channel, but no, we even found significant negative effects. And finally, that was not in this table, we also checked whether there's an effect on migrants and the environment, because there's a lot of anecdotal evidence, for example, on possible side effects of Chinese development projects on the environment. And there are also evidence that Chinese projects would come with significant inflows of Chinese migrants, but this would shift attitudes. But there, at least we have second best proxies for that, but they were all insignificant. But since income seems to improve, satisfaction with public goods, and also perceived income, we have three possible mechanisms identified. So final step is projects implemented worldwide. As I said, there's no global effect on the opinion on China, but we checked particularly country groups where China arguably cares most about. And maybe I also jump quickly to the results. So let's just focus on panel A, where we look at projects carried out in the entire global south. And we find significant effects for Africa, or continent where China arguably cares a lot about, also for swing states. So those countries that in the United Nations are in between the US and China, that sometimes vote with China, sometimes vote with the US. And this probably is also a country group where the Chinese government is particularly interested in. And we also find significant positive effects here. Final interesting result is the Chinese development projects seem to polarize the recipient populations, because we observe a negative effect in those areas where the opinion on the Chinese government is already low. And in those areas where the baseline opinion of the Chinese government is already high, we see a reinforcing effect. So we have significant positive results. Then we also checked whether there's evidence for win-win cooperation, in the sense that both the Chinese government sees its own approval ratings improve, but also the domestic government. And so we switch the dependent variable rather than asking the individuals about approval of the Chinese government. We ask about approval of the national government, and we also find significant positive effects. So we conclude it seems to be win-win cooperation. So overall conclusion, Chinese development finance increases foreign public support in recipient countries. So Chinese development finance seems to be an effective soft power tool. In quantitative terms, in the short run, project completion increases China approval by 3 percentage points. In the longer run, an additional project increases China approval by 0.2 percentage points. And then at the highest level, we observe positive approval effects in subsets of third countries like swing states, Africa, and those parts of the world that already have a positive baseline opinion on the Chinese leadership. So then to conclude, a thought experiment, just to illustrate the quantitative effects. So take a country with a high number of projects in the sample, and we took here Cambodia, which is the country with the second highest number of completed projects. So Cambodia with, as it is in our sample, 91 projects, has a 77% approval rate of the Chinese leadership. And then we can compute the counterfactual. So if Cambodia had received no aid, we would estimate that its approval rate of the Chinese leadership is only 59%. So this is what I had. So we very much look forward to the discussion.
Thanks a lot, Andreas. Questions? Sebastian.
Andreas, super interesting work. I'm wondering about canceled projects. So we know that a very significant share of the projects never reach the completion point. And I'm wondering if you ever thought or empirically looked into whether they have the opposite effect and how that would affect the net or composite effect, in particular with respect to the thought experiments you just showed on China's overall, on the effect of public opinion overall.
So I think it's a very good point. So in the analysis I've shown you, we excluded canceled projects. The problem, at least in the short term, would be that I would think that we don't have enough projects that fall into these specific Gallup survey windows to be able to compute causal effects. Maybe the total number of canceled projects would be enough to look at it in the IV specification, but probably, of course, then we would need an IV for canceled projects, which is obviously very hard to find. So I think what we can do is maybe sort of, we could do an event study that would be probably significantly less causal than the analysis I've shown you. But I think the endogeneity problem there looms particularly large, because obviously, this is what we have in mind. We would believe that canceled projects are very unpopular and probably would reduce the approval of the Chinese government. But in those instances where there are tensions between the recipient country in the global south and China, this is probably also a situation where projects are more likely to get cancelled. So yeah, probably some explanatory analysis would be possible, but probably not a causal analysis.
So I wanted to raise the issue that in much of the motivation, there's the emphasis of soft power. But sort of being precise, public opinion doesn't tell me a lot in many cases about soft power, because many of these countries are not democratic societies. And actually, in the last 5 years, if you look at indices from Freedom House, for example, the share of countries with not considered free by all their metrics has been on the rise, number of coups. And this is an area that is directly impacted, especially sub-Saharan Africa. So, this is on the interpretation. So I think your study speaks to public opinion. I'm not convinced at all that it says anything about soft power, because the decision makers can be very disconnected and often are disconnected from the populace. And so I think, looking at actions of the decision makers, voting at the UN, looking at who they side with during conflicts is going to speak to the issue of soft power more directly than public opinion. Second quick point is on improvement, increases in income. I think there we have an endogeneity issue. That lending, not just Chinese, lending in general, international capital flows tend to be pro-cyclical. So you do more projects, you do more lending when incomes are high than when they are not. So I think we have to look a little deeper into the endogeneity issue of outcomes, because the number of projects are indeed also and the volume of projects influenced also by economic conditions. So I'll stop there.
Okay, maybe let me take the first question first. So this was on soft power. So I agree with you that opinion on Main Street is probably less important for political outcomes in an autocracy compared to a democracy. Nevertheless, I would argue that it still plays a role for government survival, depending on how large the winning coalition is. It might still be relevant. The point where I disagree with you is the relevance for economic outcomes. While I see the point that in autocracy, fine, less important, I still think if there are significant private activities, and even if we were to model a bureaucrat's decision-making in, say, state-owned enterprises, I would argue that soft power plays a role. So probably in the beginning, I briefly mentioned the work by Giso in QJE, who shows that bilateral trust matters for trade and investment decision. So probably a good idea would be to split that by autocracy, democracy, by heavy SOE economies versus economies with a clear private sector, to check whether indeed the role of bilateral trust, bilateral affinity is lower in these countries. Second, on endogeneity, there probably I was not precise due to time, so we use the same IV, which is driven by the overproduction of Chinese raw materials, cement, steel, and so on. We use exactly the same IV that we use for our main dependent variable, also for in our mechanisms regressions. So obviously, if you believe that the IV is valid, then these would be causal effects. Of course, if the exclusion restriction would be violated, then we wouldn't gain much insights from looking at these regressions. But I fully agree that we look at this is a highly endogenous relationship, and it's important to look at something like 2SLS in addition to pure OLS.
I was thinking also on kind of corruption, the role of corruption in these projects, or whether there's any proxy for looking at this. Maybe I missed this in your robustness. You had like lots, but is there something you can do there?
Mm-hmm. So what we did is we just look at corruption as a potential mechanism, because if Chinese development projects tended to be more corrupt, this might also affect attitudes towards China or attitudes towards the Chinese government. But maybe what you have in mind is also sort of an interaction, or yeah, but probably I think the mechanism should probably already.
But how do you do that specifically, the corruption part? Maybe I missed it.
So we have in the Gallup World Poll also a question on perceived corruption. This question is not China specific.
Yeah,
so of course they don't ask about Chinese bureaucrats, about Chinese businessmen. So we just can check whether with our instrumental variable, whether there's a significant effect on perceived corruption. That's all we can do, and we find nothing that with more inflow of Chinese development finance in these local areas, corruption perception goes up. We even find some evidence that it goes down. So I think we don't believe that this is driving our overall effect on opinion on China.
I was thinking this is a bit like what Sebastian said, right? When these projects go terribly wrong and there's like years of coverage on how corrupt China has been, you know, what kind of whether that dampens the effects. I mean, I guess when you read Western newspapers, you tend to think a lot of these projects go bad, and you know, the public opinion should be rather negative as a result. But maybe that's very much a Western view on what's actually going on. That would be, to me, would be very interesting.
So in an ideal world, we would be able to interact maybe our variable of interest with sort of evaluation result of these projects.
Yeah.
Okay, hence it would be the extreme form of an unsuccessful project. But ideally we would have other, and there we have maybe not enough for rigorous analysis. We could check. But ideally, we would have some other sort of evaluation, and this, I think, would maybe make our results, could support our results if we find that more successful projects also lead to larger public opinion gains. But yeah, there's no systematic evaluation of these projects.
All right, thanks. Lauren.
To follow up, and again, there's probably a lot of heterogeneity, but at least in Latin America, it does seem that there are cases that the change in views are correlated with at least the press mentioning how bad some projects went. And I'm thinking Ecuador, but in Costa Rica, we have a project that started when I was in government in 2012, and it's still going on. And that has also sour. So it's endogenous press releases, but you may want to check if that gives you something. And just as a follow-up, we did get a stadium. That one is particularly very popular. And this of advertising infrastructure is very old. Like if you go to the north of Costa Rica, all the bridges say donated by the US government in the Kennedy round. So, and just to keep in mind, there was the Cold War, and our neighbor of the north was not the nicest. And so it was not by chance that all the bridges in the north were donated by the US government.
Yes, I think it's an excellent suggestion. Something that could probably be done is to automatically read out with machine learning the tone of newspaper coverage, or at least maybe it could be done for, depending on how much work it would be, it could be probably done for a subset of countries, or maybe just with the sources that underlie our entry in the 8 data database.
Or
I found very
more democratic ones when it would matter.
Yeah, And I found very interesting that you mentioned the bad media coverage, yeah, which is also very much in line with what we saw descriptively, that approval of the Chinese leadership is particularly low in Latin America, which is very different from sub-Saharan Africa, where, at least based also on my own travels, I feel as countries I have been, there's a very positive coverage in the newspapers. But I think, yeah, it's a great suggestion to do something with the media reporting as the second best solution, as we have no independent or not evaluations at all. Yeah, thanks a lot.
Great. I've got no further questions. I'd like to thank you for the discussion and for the presentation in particular. Great. So we'll move on to the last paper of today. Sebastian will present it. It's by Sebastian, Brett Parks, Carmen, and myself. China as an essential lender of last resort.
Thank you, Christoph. As you mentioned, this is joint work with Brett Parks, Carmen, Christoph, and it's called China as an International Lender of Last Resort. Let me emphasize that all these views are personal, do not necessarily reflect the views of the World Bank. I'm in the fortunate position to have two co-authors on the panel. So Carmen, Christoph, if you want to add, please come in. So in this project, we document that China has created a new cross-border system of rescue lending with more than $200 billion extended to more than 20 distressed sovereigns over the past 15 years. We show empirically that this rescue lending is targeted at countries of the Belt and Road that are highly indebted to Chinese banks. And we argue that through these flaws, China has created something akin to a regional safety net for the BRI, but by extension, of course, also to the Chinese creditor banks that are highly exposed to these countries. Let me set the stage by showing you this graph, which shows the share of China's overseas lending portfolio that has gone to countries that can be considered in debt distress. The way we built this is very simple. We take loan level data on all Chinese overseas loans to the developing world. We estimate the amounts outstanding for each of these years, and then identify those debtor countries that are in default, that have substantial arrears, that have recently restructured their debt with China, or that are at war. And you can see that the share of the portfolio that can be considered in distress or exposed to distress has risen from around 0% 15 years ago to 60% as of 2021, right? And in part, this reflects the series of global shocks, the COVID pandemic, rising US interest rates, the war in Ukraine. But of course, on the other hand, it's also a function of China's high-risk lending strategy that has put a lot of portfolio weight on countries like Venezuela, Pakistan, or Russia. And indeed, during the past 10, 15 years, there has been a rising number of credit events with Chinese banks. We have seen this before in this workshop, so I will not spend any time on this. What we do in this paper is that we study how Chinese banks and the PBOC have responded to this distress situation, and we document that there's a new system for cross-border rescue lending with around $240 billion in financial assistance extended to more than 20 distressed sovereigns. And we show that this assistance has come through two main channels. On the one hand, we argue that the PBOC swap network is increasingly being used as a financial rescue mechanism. And we show that Chinese state banks and enterprises have provided substantial balance of payment support through a whole variety of financial instruments. And we show empirically, and this is very much in line with economic priors we have from theory models, this rescue lending has been targeted at BRI countries to which Chinese banks face very high exposure. So in this sense, it's very much reminiscent to the Eurozone bailouts that we have seen, but also to the long history of US bilateral bailouts, in particular in Latin America. At the heart of this project is this new data set of China's overseas rescue lending, and we've put this data out. I want to spend a couple of minutes describing how we put it together, what's in there, and hopefully this is also useful to others who are looking into these topics. There's no uniform definition of what constitutes a cross-border rescue loan. So here we focus on the de jure purpose of these transactions and count all official Chinese lending that can be used to pay existing debts, to finance general budgetary expenditures, and or shore up foreign exchange reserves, thereby potentially enabling future debt service payments. And this assistance has come through two main forms. On the one hand, we show here that the PBOC has provided very sizable liquidity support to foreign counterparties through its RMB swap line network. This swap line network has been studied in the literature before. You probably know there are close to 40 bilateral swap agreements outstanding. Our key contribution here is that we are the first to actually quantify which foreign central banks made drawings under this network, by which amounts and when. And this data allows us to characterize a number of use cases for the recipient countries, in particular to use the drawn down renminbis to prop up the foreign currency reserves. And this liquidity support through the RMB swap line network is supplemented by different instruments of China's state-owned banks and enterprises, general purpose loans, in particular by the CDB, term deposits that China's banks have deposited at foreign central banks, and also commodity prepayment facilities that state-owned energy companies have made to resource-rich debtor countries. The way this works is that an energy company would make a large upfront cash payment for future, for example, oil deliveries. Let me just one clarification, say that when I say China in this context, we're always referring to the universe of state-owned banks and other enterprises that have engaged in cross-border lending. How do we construct the data? So we basically follow two distinct data collection steps. The Chinese authorities do not publish this sort of data, definitely not at the granular level. So what we are doing here is that we are systematically searching for relevant lending transactions in official and non-official sources. And this identification and triangulation approach that basically cross-checks information between different sources follows the 8-data team that Castro et al. Reference. For the swap line drawdowns, this primarily means that we are working through the annual reports, press releases of all the recipient countries' central banks. And then in a second step, we validate the data that we get from these micro sources by comparing it to the recipient country balance of payments or debt statistics. So basically for each drawdown from a swap line that we find, we would go through the BOP statistic and see if in the corresponding year and country, is there a corresponding uptick in the inflows from currencies and deposits, for example. And this way it's very reassuring to see that what we identify in the micro sources, in most of the cases, very closely tracks what we see in the balance of payments data, also in the short-term central bank debt statistics. When we put this together, we get 128 separate rescue operations to 22 borrowing countries, spanning a bit more than 20 years. And we basically collect all the information we can find, right? The stocks, the flows, and then whenever possible, also the terms of the lending, interest rates, maturities, and possibly collateral. And as I mentioned, this data is on our website, so feel free to have a look. We hope it's useful to others as well. Now, before I show this entire database, I want to say a few words on the PBOC swap lines, because there it's not probably not entirely obvious how this constitutes cross-border rescue lending. What is well known is what you can see here on the black line is the PBOC over the past 15 years has signed 40 bilateral swap line agreements. What's novel in our paper is the granular data that underlies the red bars here. By tracking which countries made drawdowns and when, we show that at least 17 of the recipient countries have by now, as of 2021, activated their swap lines with the PBOC. So after a fairly slow start, right, this network has gained traction. And the data we collect is interesting because it allows us to characterize the macroeconomic circumstances under which the recipient countries' central banks have made use of their swap lines. What's pretty evident from this data is that the swap lines are mainly activated by sovereigns that are in distress. We have a regression in the later part of the presentation, but the raw data is actually quite interesting. What you can see here are swap line drawings in percent of the drawing rights on the vertical axis, and then net reserve holdings, the measure of reserve adequacy, on the horizontal axis. And you can see that the large majority of drawdowns has occurred while net reserves were lower than roughly 5 months of imports, so at fairly low levels of liquidity. And this is well, officially the main purpose is to promote trade settlements in renminbi. This is also the primary angle through which this has been studied in the academic literature. For example, in the paper by Salim and Ricardo, but we show that the swap lines here also additionally and increasingly used by distressed sovereigns to meet their short-term liquidity needs and to bolster their cross-reserve holdings. And in the paper, we have an appendix in which we study the contextual information for each of these drawdowns and find indeed evidence that a key motive to draw on a swap line is to meet reserve adequacy targets and to meet short-term liquidity needs. So there's 17 countries that have drawn down on their swap lines, and for around 13 of them, we find evidence that meeting foreign exchange targets has been an important part of the motivation. There are 4 other recipient countries, Malaysia, Thailand, Singapore, Korea, which have used these purely for trade promotion purposes. These we exclude from later parts of the paper, in particular when we calculate the aggregate amounts of rescue lending. And with all of that being said, we can put together the total bilateral rescue lending amounts. You can see them in this graph, which just adds up the swap line drawings, including all rollovers. This is important, as we'll see on the next slide. And also the second channel, the BOP support from state-owned banks and enterprises, again, including all rollovers. And you can see that in 2021, total rescue lending was around 40 billion USD. So it's a fast growing series. And if you add up all the amounts across all years, you arrive at around 240 billion USD, which roughly corresponds to 20% of IMF lending during the same period of time. We don't want to overemphasize this comparison simply because the IMF lending and the Chinese rescue lending that we are tracking here have very different maturities and are therefore very hard to compare. But if you include all the rollovers, you're at around 20%. If you exclude them, you're at around 10%. So it's clear that regardless of how you add them up, this is still much, much smaller than the IMF's rescue lending operation. And it's being dwarfed by Fed swap lines, right, which are not being shown here. If you look at this data at the country year level, what's striking is that many of these rescue lending operations go to the same country over and over again. If you look at countries like Argentina, Egypt, Mongolia, and in particular Pakistan, they're making use of the same sort of liquidity assistance instruments from Chinese creditors again and again and again. So they have instruments that truly have very short maturities of around a year, but then they're being rolled over for many years in a row, so that their de facto maturities often exceed 5 years or even reach 10 years. That's interesting because that's a pattern that, for example, you do not see for the Federal Reserve's modern day swap lines, which usually spike in response to some sort of counterparty financial sector distress. But here you have these protracted balance of payments crisis in the recipient countries, and therefore repeated rollovers that basically match the long nature of the underlying distress. Now, in ongoing work, we are asking the question, what is driving these rescue lending flows? And we're following a key hypothesis here that is motivated by recent theory work in the literature, in particular by a number of models and papers that are motivated by the Eurozone crisis, and that ask why countries engage in cross-border bailouts, why they have an incentive to help countries abroad to withstand sovereign debt distress. And this key hypothesis is very intuitive. It basically says, well, rescue lending is always targeted at those countries to which your own banking sector has the highest exposure, simply to limit negative spillover effects from the foreign country. And we test this empirically here, and we show empirically in ongoing work that indeed the debt service payments that these countries make to Chinese banks, they're very good predictors of the actual rescue lending amounts. And we also show, and we interpret this as some sort of evidence for evergreening or defensive lending, that the net transfers between the Chinese rescue creditors or between Chinese creditors and the debtor countries are close to zero, despite the new commitments coming from the rescue lending. So basically, the disbursements made through the rescue loans are more or less immediately eaten away by the repayments on principal and interest that these countries need to make on their existing loans. And drawing these two properties is quite challenging, again, for measurement reasons. So what we do is that we build granular new data sets on the debt service payments and the net transfers between the Chinese creditors and their developing country sovereign borrowers. So this will be the regression framework that I'm showing you later. This will be the main explanatory variable on the right-hand side. Let me say a few words on how we estimate the debt service that is due to Chinese banks. What we're doing is that we use loan level data from data from Castro et al. That has commitment amounts, grace periods, maturity, and interest rates for more than 3,000 Chinese loans to developing countries. And we use that data and map it into outstanding debt stocks and the principal and interest payments for more than 120 developing countries. And in order to do that, you basically need to make two assumptions. On the one hand, you need to make an assumption about the speed at which these loans are being dispersed. For that purpose, we use data that is quite similar to what Andreas just presented. We have data from data, I think a subset of what Andreas uses in his paper on the implementation timeline of around 1,000 PRI projects. And we use that to basically calibrate how fast these loans are being dispersed on average. And then on the other hand, you need to make assumptions, or you need data on the repayment schedules that these loans typically have. And to get this data, we draw on the lending contracts that we collected in a project 2 years ago in Göttingen et al. And create a typology of how Chinese loan instruments are typically structured and how their repayment and interest schedules look. Don't want to go into too much details here. That's actually quite straightforward. Most of them require some sort of semi-annual interest and linear repayments. And we can use all of that information to estimate debt service. Final note here, our estimates also account for fluctuations in variable interest rates, for fluctuations in exchange rate. And we also implement changes due to debt rescheduling agreements, in particular the SSI. So this is what we get after this exercise. You can see that debt service payments made to Chinese creditors have been rising sharply over the past 15 years. So our data is on the loan level, is granular, so we can basically distinguish by Chinese creditors. And you can see that the lion's share of these flows need to be made to China Exim Bank, the CDB. Here you can see for China Exim Bank, you can see a small dip here in 2021 because it was a major contributor to the DSSI. But other than that, it's been a steadily rising curve. And we link this data now on debt service payments to the rescue lending patterns that we observe. And you can see that it's indeed a very good predictor of the rescue lending in our data. So showing you just the raw data here, basically collected in several different bins and categories. The way to read this chart is that on the horizontal axis, we split all the country year debt service observations into 3 different groups. And then we plot conditional averages of the rescue lending in % of the recipient country's external debt stock. And you can see that if you look at the full sample, the black line, there's a positive correlation between higher debt service to Chinese banks and rescue lending. And this correlation is particularly steep, particularly pronounced if we're only looking at country year observations in which the sovereign recipient had very low levels of reserve, right? So below, say, 5 months of imports. The threshold is not very important here. A key issue with this purely correlational graph is that we might think that debt service to China and rescue lending by China, the rescue lending by China and the initial project lending could be driven by the same unobserved or observed factors. So what we're doing in the next step is that we're putting this into a very simple regression framework where we can control for potential confounders. And here our dependent variable is just the rescue lending. We're combining the swap data drawings and the swap drawing data and the other BOP assistance data, but you can also do it separately and the results look quite similar. We are regressing that on our measure of the debt service that I just showed you and on an interaction term between the debt service and the reserve liquidity ratio. And in the first 2 columns, I'm just showing you basically a pooled panel OLS regression. All of the variables are standardized here. So the way to interpret this is that one standard deviation increase in debt service due to Chinese banks is associated with an 0.25 standard deviation increase in rescue lending by Chinese creditors. And what's, I think, most interesting and remarkable here is that when we move to the right, we're adding additional control variables that have been found in the literature to be important determinants of China's project lending, is that even when we control for country fixed effects to account for potentially unobserved time fixed effects that might be driving both project lending and rescue lending, we find that within countries over time, debt service payments and net reserves remain very important predictors and have high explanatory power for the rescue lending that we see. And then in line with that, a second point that I want to make is that we can also use this data on debt service payments and project lending to construct measures of net transfers between Chinese creditors overall and their recipient countries, and then look at how net transfers behave in the years before, during, and after the rescue loans. And we are plotting that here. Again, we have net transfers in % of the external PPG debt stock on the vertical axis and a time axis on the horizontal axis. And you can see that the rescue loans typically come, this is the median, also the way it looks very similar for the average. The rescue loans typically come at the end of a pronounced lending boom. And although they promise large new disbursements and large commitments, the net transfers in the immediate aftermath of these rescue loans is very low, right? So we take this as evidence for evergreening. The new lending provided through the rescue loans essentially is eaten away by the principal repayments and the interest payments on the existing liabilities that these countries have. Let me wrap up with this. So basically, we show in this paper that China's overseas lending boom has increasingly shifted from the project financing of the early stages of the boom to rescue lending. As a result, China's role as an international crisis manager has grown considerably. The volumes and the centrality of its lending still make it far from rivaling the central positions of the US Fed and the IMF, but it has created something akin to a regional safety net. And we saw that in line with the predictions and also a large history of other creditors going the same path, its rescue lending has been targeted at countries highly indebted to China. And as I mentioned a couple of times, this is something we also see in another research project, in particular, if we look at US bilateral lending, that starting from the 1930s was extended to a large number of countries, in particular in Latin America, that had large liabilities to US exporters and banks. So in a sense, China is following the same path that the US has taken several decades ago. We're also emphasizing in the paper that it's not just a Chinese phenomenon, but one that also applies to other rising creditor powers, and that signals something akin to a deeper shift to a more opaque, fragmented, and multipolar international financial architecture. So there's lots of research left to do on these patterns. I'll stop here.
Great. Thanks so much. Reactions, questions. Andreas, you were the first.
Yeah, really great paper and great data contribution, the overseas rescue lending database. Maybe first, as the data nerd, I would be curious to learn more about those cases where the balance of payment data didn't fit. So do you know why these cases can happen, why there might be disagreement, disalignment between the two databases, and how did you settle those cases? Then I found this evolvement over time very interesting of the liquidity support by SOEs the swap line drawings, and then the composition changed over time. So do you have explanations why the composition changed over time? And is there any general pattern why, for example, Ecuador was on in a SOE bank liquidity facility and Argentina was a swap line? So I think this would be great. And the third point is Montenegro came to my mind, the Montenegro case where the EU first refused to bail out Chinese loan and then was willing to bail out a Chinese loan. So generally, I think third countries were missing in your discussion, in your paper. Do you plan to integrate third countries' effects? Because I find these cases very interesting and probably can also learn a lot from that. And very specifically in your regression in the end on debt service payment, when you request rescue lending on debt service payments, you included only Chinese debt service payments. So obviously, it would be great to see whether there are any third country effects. But yeah, thanks.
Thank you, Andreas. Many very good questions. So I was a bit imprecise on the first one. We do not find cases where the balance of payments data is really contradicts the collection from microdata. This sort of comparison between microdata and balance of payments data works very well if the swap line lending is very large in relation to other flaws that are recorded in the balance of payment, right? So countries where the swap line drawdown makes up, say, 50% of total external liabilities of the central bank, you can usually very closely track the coincidence of both. But then there are cases where the swap line drawdowns maybe just account for a couple of percent. And then it's very hard if you're looking at the big aggregate to find the co-movement of these patterns.
So it was more a validation, and it's not that there's a significant number of disagreement between.
Exactly. Yeah.
Okay.
Exactly. On other countries, so I'm not particularly familiar with the Montenegro case. I mean, a general thing that we see, and I think that's backed up by our analysis of the debt service payments, is that China has rarely basically provided lending to small countries, right, that do not matter from the perspective of its banks. So the countries that are in this list of rescue lending recipients, they're all fairly sizable, and their debt service payments actually in USD terms are sizable with respect to Chinese banks. For most of the small countries, also the poor countries, what we observe is that they rather get debt restructurings with Chinese creditors rather than fresh money through these rescue lending operations. And just to be clear, I was probably a bit fast on the regression. We include basically the full universe of developing countries. I think we have 127 countries in the regression analysis. So this extensive margin, right, zeros and ones, is incorporated in there. What we are indeed missing, and you're absolutely right, is something we are working on, is to also see whether debt service to other creditors, in particular to private bondholders, plays an important role. There we are still constructing data. We are also interested in seeing whether debt service payments, for example, to Paris Club creditors, right, have an important role, positive as well as negative.
So thanks so much. You can hear me okay?
Yeah.
Yeah, perfect. Thank you. Sorry, I can't turn my camera on today. So, I mean, it's really fantastic work. I love how you went this paper. Just a couple of comments. First, I was wondering if you could say a little bit from the balance of payments that you have, a bit more where the money went in each individual case. So obviously you can see whether reserves were padded or whether there was a change in debt stock, for instance, externally. So whether we can sort of decompose these different drawings into different types. I know the Argentinian case is clearly a case of reserve padding, but for the others, it wasn't quite clear to me exactly what was happening once the money was drawn from the swap line in particular. The second thing was, there's this interesting case in Russia this year where they've used the swap line to have a new RMB facility from their central bank with the PBOC. I was just wondering how you would classify that and whether how that sort of fit within the framework you have. Is that like Singapore, or is that like Suriname? I guess that's sort of a question that I had in terms of your thinking. And lastly, I mean, there's also a thing about currency mismatch here, right? So typically, I would imagine that the loans that Chinese banks are making are in dollars. I'm not sure precisely, that's my prior, but the swap line drawings are always in RMB by definition. And I was wondering whether there is something you can say about currency mismatch. It's obviously a stress on the PBOC's reserves if they are replacing dollars for RMB, whether they're more likely to lend if the loans aren't denominated in dollars, for instance, and whether you can say something about that.
Thank you very much, Celine. Yeah, very good point. So what we're looking at when we look at the balance of payments data, what we're looking at in detail is a series called the foreign currency and deposit inflows to the central banks. And usually you see in most countries, right, you see that at the time of the swap line drawing, these go up. And then as these swap lines are getting rolled over, as you've seen in that one graph, the series remains elevated. We would love to do more. We would love to do more to see how recipient countries actually utilize these drawings, right? That remains in most countries really hard to find out. We have evidence in line basically with your papers in countries like Singapore, Korea, that they are auctioning these off and to private sector banks to finance trade. You see that in a number of countries, but then again, as mentioned, like in this around 13 countries, you see that the foreign and currency deposits seem to just remain on the central bank's balance sheet. And speaking to your third question, we know that some of these countries have an explicit authorization to exchange them into USD, but we do not know whether that's the case for a larger group of countries, right? Argentina is one that has made this sort of supplementary agreement public, but for many of the other countries, we simply do not have that information. I mean, at the minimum, right, holding large RMB reserves might free up other USD and enable the recipient country's central bank to spend those other USDs for debt service or other expenditures. You're proposing this very interesting test to look at whether the currency composition of the project lending, right, has an impact on the sort of instruments that these countries get from China when they're being rescued, that's something we could try. Yeah, we haven't looked into that. And finally, on Russia, I would need to look at the details of the case. I'm not familiar exactly with that new instrument.
Maybe let me come in here too briefly. So I think, I mean, we would love to know for every country how this is used, what they swap, what they change to US dollar, what they don't. We have indications that they do in several cases. And I guess the strength of the paper is really that we can get, since the lending by China is bank-based, we can now, so we've only started to use this granular, to exploit this granular data. I think there's a lot of potential there in the direction that Sebastian was now saying, but we can really see debt coming due across these different creditors in China. And we can then link it to the bailouts. I'm not aware of another paper that actually can trace kind of the drivers of bailouts, the determinant of country bailout on this level, because usually you have the bond flows and you don't know who holds this stuff, who the debt is owed to, etc. And here you know it exactly from the bank lending. So I think our hope, Salim, is that we can infer more. I mean, we already infer for the first time when these swap lines are drawn, which countries receive them, and we show that that is in distress. So that sheds a lot of light on the usage of the lines. But I think the next step is really to show that this is quite very likely used to repay debts. Right? This is where we're currently digging deep and using this micro level data. I think that's kind of to me the coolest part of the data and the setup. Yeah, modern. Laura.
I was reading what you wrote for Argentina. I remember that when Carmen presented, Federico Zutzenegger basically said what they were using it for and not using it for. But I will read in more detail to see. But so I had a question on your comment that there seems to be increasing creditor powers that you were sort of suggesting is not related to the rise of China, but it's hard to think that it's not, because all of this has happened in a time of low interest rates, which one could argue have been low because of quantitative easing and bad times, but those bad times have been mostly been in the north. For emerging markets, there has been a lot of money going around. If you look at what's happening in tariffs, in trade and industrial policy, there seems to be an increase in sovereign tariffs and intervening in the economy because of China. So all of these trends does suggest that the power of China and the fact that everything is centralized done by government, it is pushing all of these trends, but maybe I'm oversimplifying.
No, I mean, I fully agree. Just to clarify, the point is that we're seeing this increased cross-border, fairly opaque rescue lending, not just from China, but also from, for example, Arab creditors that have put large deposits to central banks in Egypt, Pakistan, and so forth. So there seems to be a broader shift, but I fully agree that China is the main actor in this space.
Wasn't Saudi Arabia always shady?
Well, I think they've long basically practiced this sort of dollar diplomacy, but if you're looking at volumes and the wide range of the geography of the recipients, I think there has recently been an uptick. I mean, driven by oil prices in particular, but I think this phenomenon has really increased in importance.
To the point of other powers, the rise of non-Paris Club. Laura, I think we also have greater awareness because of China, not necessarily that they weren't doing it before, but that we have greater awareness. the reserve accumulation of Arab states during the oil boom of the 19, the late 1970s and so on, led to fueled the recycling of those petrodollars, fueled a lot of the emerging market lending through the LIBOR market, but also even directly in early 2000s when I was at the IMF as deputy director there. The discussions with Lebanon, this is early, 2001, was no, they didn't need the IMF because they had the Arab state. So it's not all China driven, it's an important point, and the timing of particularly Arab lending is even, possibly earlier than China. On the earlier point, the earlier discussion on countries borrowing in renminbi but having dollar debts and the issue of currency mismatch, I think, as Sebastian noted, we're really working to see what, and Christoph mentioned this too, what countries do with the PBOC swap lines. But my understanding from not at this stage, a comprehensive data, but a number of episodes, that the renminbi is convertible to dollars. Remember, the renminbi is not a convertible currency. Countries, whether they're using it to shore up their reserve holdings or to repay Chinese debt, they need dollars. And I don't think this puts a strain on the PBOC. The PBOC saw the lending, part of the lending fuel came from the PBOC making loans to dollar loans to the development banks. So this was a form of sterilized intervention when they were saturated, when they were getting the large dollar inflows. They were saturated with holding US government securities, and they wanted to move away from government securities. Lending abroad in dollars is a way of sterilized intervention. Basically, you're acquiring other non-dollar US Treasury debt. This is not at the scale that it would strain the PBOC. This goes back to the earlier discussion.
Laura, maybe just one minor point on has this always happened? I think what's new is really the use of swap lines, right? And to my knowledge, this paper is the first to trace to study kind of the how swap lines are used as bailout mechanisms. So swap lines have a long history. We have kind of a subset in the disasters paper. So it has always played a role, but this is a particularly extensive use of this tool. So I think and in these other Arab countries too, right? I think the 1970s took other forms as Carmen noticed. And we're likely going to see more of that coming, right? Towards in a way, a new architecture emerging that is less structured, less clear, less transparent. Yeah. All right. Any more questions, comments? Okay, so this concludes the workshop. Thanks very much for fun today. This was great, and we're happy we did this. Hopefully next time we'll be in person with a fresh batch of China papers in 2 years maybe. And yeah, so have a great day, evening, morning, wherever you are, and see you in person hopefully soon. Thanks a lot to everybody also listening online. Thanks a lot.
Thank you, Chris.
Cheers.
Thanks so much for putting this together.
Thank you very much.